Is the AI stock boom losing steam, or are we just catching our breath before the next big surge? Over the past couple of years, artificial intelligence has been the hottest story in the market. Companies tied to AI, whether through chips, cloud computing, or software, have seen massive gains, driven by excitement around tools like generative AI, automation, and machine learning. Investors piled in, valuations skyrocketed, and the narrative became almost unstoppable. AI is the future, and the future is now. But recently, cracks have started to appear, and many investors are asking a crucial question. Has the hype run ahead of reality? Let's start by understanding what fueled the boom in the first place. The explosion of interest in AI wasn't random. Breakthroughs in large language models, rapid enterprise adoption, and aggressive spending by tech giants created a perfect storm. Companies began integrating AI into everything, from customer service to software development, and markets rewarded anything even loosely connected to the trend. Earnings calls were filled with AI mentions, and investors interpreted that as a signal of future growth. In many cases, stock prices moved not on current profits, but on the promise of what AI could eventually deliver. But here's where things get more complicated. Markets don't move in straight lines forever. After a period of intense optimism, reality tends to step in. Investors are now beginning to scrutinize whether these companies can actually deliver the revenue and profits needed to justify their valuations. Building and running AI systems is extremely expensive. Data centers, specialized chips, and energy consumption all add up quickly. For many firms, the costs are rising faster than the returns, at least for now. Another factor contributing to the slowdown is expectations. When expectations get too high, even good news can disappoint. A company might report strong earnings, but if it doesn't exceed sky-high forecasts, the stock can still fall. This is something we're starting to see more frequently in the AI space. Investors are no longer satisfied with potential. They want proof. They want to see real monetization, sustainable margins, and long-term business models that make sense beyond the hype cycle. There's also the broader economic environment to consider. Interest rates remain relatively high compared to the ultra-low levels of the past decade. Higher rates tend to pressure growth stocks, especially those valued based on future earnings. When money is no longer cheap, investors become more selective. They shift from chasing hype to focusing on fundamentals. That shift alone can cool down even the hottest sectors, including AI. Now, this doesn't necessarily mean the AI boom is over. In fact, it's important to separate short-term market behavior from long-term technological trends. AI is still advancing rapidly, and companies continue investing heavily. What we may be witnessing right now is a transition phase. Early hype is giving way to a more mature market, where winners and losers become clearer. Not every company that claims to be AI-powered will succeed. Some will struggle to turn innovation into profit, while others could become dominant players over the next decade. For investors, this shift is critical, requiring more careful analysis and patience rather than hype-driven decisions. In the end, the story of AI in the stock market is far from over. The real question isn't whether the AI boom is over. It's whether you're prepared for what comes next.